And we are live. Welcome everybody to the End of the Road webinar. It's being offered in conjunction with Peak Prosperity, Benchmark Financial, and Jefferson Financial. Backstory on this webinar is I'm Adam Taggart, co-founder of Peak Prosperity. My fellow co-founder Chris Martenson and I. One of the things we write an awful lot about is the brewing insolvency crisis. We spend a lot of time talking about it, amongst ourselves, trying to figure out what the repercussions are going to be. But one of the things we love doing best is reaching out to other intelligent minds that can bring additional pieces to the puzzle together. And we thought that as we were doing this, rather than keep it to ourselves, we wanted to give everybody a front row seat as to sort of what this process looks like. So that's what you're going to see tonight. A little bit of the backstory. For decades now, the central banks have been on a true bender. This is obvious pretty much to anybody now, seeing how much liquidity that they've pumped into the world economy since the great financial crisis in 2008. But it really began much longer ago, back in 1971, when Nixon took the US dollar, the world's reserve currency, off the gold standard. Interesting fun fact, that was 2 weeks after I was born. So if you want to know how long we've been on the current monetary regime, it's as old as this guy right here. Still an experiment in process. So every time that things have gotten a little bit hairy, growth has begun to slow. The central banks have rushed to the rescue with more liquidity. And of course, they've been egged on and encouraged by politicians who are looking for easy solutions and to be able to avoid making tough choices. Of course, this has allowed debt to just balloon in the system. U.S. debt has now exceeded $22 trillion. Actually, if you look at total credit in the U.S., that's over 70 trillion these days. And that's not even including the unfunded liabilities like pensions and Social Security and Medicare. You add those things in, you're well over $200 trillion. And the meaningful part about that sum is that it's a sum that'll just never be paid in full. It's going to be defaulted on in some way, shape, or form, either by bad debts being extinguished, which is highly deflationary, or by just printing money to service those debts, which is highly inflationary. So either way you go, it's a default. It's kind of a pick your poison type scenario. And of course, we're at a point right now where it's getting harder and harder to add those debts without consequences. Even with record low interest rates, the costs of servicing those debts are becoming a huge drag on economic growth. And of course, this is still within the longest economic expansion in our country's economic history, right? And we know that that can't continue forever. So here we are today standing at the pinnacle of the everything bubble, where assets of all types and kinds, stocks, bonds, real estate, really you name it, have been distorted by this excess liquidity to record all-time highs. And as we look at the current data now in 2019, increasingly that data is showing that the global economy is really beginning to slow down. In fact, ex-US, the world is really fast falling into a global recession, and the US is not going to be immune to that. So you take those together, and really what we are looking at is we are looking at staring an insolvency crisis in the face. And we have kicked the can as far as we can, and we're now getting to the point where that can is really hitting the end of the road. So this raises a couple of key questions. One, what are the big repercussions going to be from that? And then secondly, what are we and you, as prudent, concerned individuals, what can we do today to position ourselves for those repercussions so that we're not going to be collateral damage when the next crisis hits? So to help us make sense of all this, we've assembled a team of experts. Starting in order that they'll be presenting today, we have Chris Martenson, who's the co-founder of Peak Prosperity along with me. Chris is best known for his Crash Course video series, which came out in 2008 and really explained to the world why the great financial crisis happened. It's been viewed over 12,000 times, translated into more than a dozen languages around the world. He also co-authored the book Prosper, which does a great job of moving from just talking about the problems to talking about the type of solutions that we're going to need in the future. And Chris is an advisor to investors, to family offices, universities, corporations, governments, and governmental agencies like the UN. Chris, great to see you.
Hey, great to be here. It was 12 million times on the views on the Crash Course, though. So
what did I say?
1,000. I mean, come on. You can get more than that with a single puppy that does something half cute. So I just wanted
to. You just need even a not even great looking kitten, and we're already twice that. All right, then we have Ted Siedle. Ted Siedle is a former SEC attorney. He's pioneered over 1 trillion, and that is trillion, not thousand, trillion, in forensic investigations on into the money management industry. He's a recognized authority on pensions. He's testified before the Senate Banking Commission on this topic, as well as on other types of financial abuses like the Madoff cases. Ted's got the distinction of being the recipient of the 2 largest whistleblower awards ever awarded by both the SEC and the CFTC. Ted, thanks so much for joining us today.
Thank you. Thank you very much.
Following Ted, we'll have Brien Lundin. Brien is the CEO of Jefferson Financial. He's probably better known as the author of the highly esteemed Gold newsletter, which provides analysis on precious metals mining companies to investors. He also produces the New Orleans Investment Conference, which is the longest running gathering of investors in the world. Brien, great to have you.
Great to be with you. And Gold newsletter was started in your birth year, Adam, so it's as old as you are.
Good company to be in. Thanks, Brien.
That's it.
And then once we have these big brains talk about the key risks and the repercussions, where they're going to be followed up by advisors who can help you put this into action. So at Peak Prosperity, the most common question we get to folks that come in and engage with us on these type of topics is, okay, I get the risks. How do I translate them into action? How do I act? What do I actually do with my own life, with my own portfolio, with my own money to make sure that my wealth isn't destroyed when the reckoning of the hitting the end of the road really arrives in force? So we're going to be joined after these 3 speakers with their presentations by the lead partners at New Harbor Financial. That's Michael Preston and John Lodra. Hi guys, how you doing?
Hello. Thanks for having us.
Hello, everybody. John, and that's Mike, obviously.
Well, thanks for joining us, guys. And so for those of you watching, we're going to leave time at the end here, as much time as we can, for you to basically ask them any questions you have. We do this from time to time online where, of course, it's not personalized financial advice. They need to talk to you and get a full backstory on your unique situation, but they can handle a lot of the higher level questions that investors have about what specifically investors should be considering given the macro environment that we're now living in. So with that being said, Chris, I'm going to hand the baton to you. I understand you've got some data you want to walk folks through.
Absolutely. Thanks for that, Adam, and welcome everybody. Thanks everybody for coming here and spending this evening or afternoon with us, depending on where you live. We have a lot of really important information to present today, and the basic model we're going to follow here is that we're going to go in a funnel. We're going to start big and we're going to move our way down through. So I'm just going to set the stage, put just a few slides up that we're going to talk about some of the macroeconomic things that are driving this, some of the big decisions. Our work at Peak Prosperity is all about getting you to a place where you have enough context, enough education, where you have enough awareness and alertness to go ahead and take some sort of action around that. So information without action, useless to us. We're hoping to bring a lot of very actionable information to you today. And it begins with an understanding of where we are in this economic cycle, in this monetary cycle. Adam mentioned a big one going off the gold standard. Well, that was just really the start of something. Who knew how crazy it could get? So I'm going to break eye contact here for just a second as I go down and share my screen, and I'm going to be bringing up some slides here to go through. All right. So, Adam, just let me know if you can see that. Everybody's with me on this?
Looks great, Chris.
All right. So as we go through, if you have any trouble viewing any of these things, if you do see a little box of heads to the side, you can move those around if you need to. Otherwise, this is should all be very visible. So it all starts here. This is just a plot of 3 things. It's world stocks and their prices, world bonds and their prices, and the G3 central bank balance sheets, fancy name for tracking the amount of money printing that the central banks have gone through. So the green line is stocks and blue is bonds, but that red line is central bank balance sheets. This is just covering 2016 and 17. There's a reason I picked that particular time frame, and we'll get to that in just a second, which is now. It turns out we had this crisis back in 2008 and 9, and there was this big burst of printing. Hey, it was an emergency. Remember, we were looking at possibly having martial law, and there was everybody was worried about a systemic crisis. Maybe the banking system was going to melt down. I get it. We had that emergency, and then the banks started to pull back on their printing. So what we're looking at here is the total assets of all the major central banks, and it's looking at the yearly change. So if you see a number like 2, that's $2 trillion in the last year had been added to the central bank combined balance sheets. So roughly the size of those orange circles shows you roughly how much printing, just to give you some scale on this. So we had that printing in 2009, and they started to dial it back, thinking, okay, we've done this. We've done the quantitative easing. We printed the money. Let's stop that. Well, then stocks started to roll over, and they didn't like that, so they printed more. And we saw all this printing in 2011 and 12. They tried to pull back again. Then we had another pullback, 2013. Things looked dicey again, so more printing. They pulled back, and then things got really dicey. And you may not have been aware of this, but the largest amount of printing so far in the entire series since the crisis began was in the years 2016 and 17, coming into 2018. So what was the crisis? Well, the crisis was stocks started to roll over again. So here's a monthly chart of the S&P going back, and we're seeing that this bubble we're in right now, which is represented at the tail end of that big red swoop, this is the third one. We had the internet bubble, which was due to all sorts of monetary printing back in the 2000s. Then we had the housing bubble, which is that second bump in the middle of this chart. And now we have this third one. And if you notice, right there at the corner of that orange legend up there, you can see 2016 where there's a clear topping pattern. Stocks were starting to roll over. The central banks got very scared. That's when they printed like crazy. And that last parabolic burst, hey, that's where we are right now. And it wasn't just stocks. This is being called the everything bubble. So the blue line here, we're looking at the net worth of U.S. households, which adds up on a net basis. What is their real estate worth? What are all of their financial assets, stocks and bonds worth? You add all of that up. And what you see is there was a dot-com bubble, a housing bubble, and now the central bankers bubble. Under that, in orange or red, or however that's displaying for you, is U.S. nominal GDP. Now, why is that important? Well, your assets always have to be in relationship to your income in this story, because those assets, that blue line, those are claims on the income. They're claims on GDP. So they really ought to be very closely aligned. And when they get apart from each other, that's when you have a bubble. So here we are with a third bubble in a row, and our central bankers are serial bubble blowers, and they are terrified of the idea of this third one breaking. Bubbles, man, they're hard to resist. Love this chart. This shows a famous person in a famous bubble. This is the South Sea stock bubble. It was around a crazy idea of a company that was selling stock in a really amazing scheme back in the early 1700s. And Sir Isaac Newton, hey, he invented calculus, pretty smart guy, right? He invested a little, and he got out. He tripled his money, made a huge fortune. But then his friends were all getting rich, and he's going to parties, and maybe, attractive people are saying, hey, Isaac, how come you're not in the South Sea, company stock share? So he got back in, and then he exited finally a couple years later, totally broke. He lost 20,000 pounds, which at the time, you could have bought a whole country for that. So very smart people find bubbles really hard to resist, and I get it. They really are. Right now, looking at just stocks, we're seeing them at the most expensive that they've ever been by another measure. So here in the blue line, that craggy mountain peaky thing on the top, now we're looking at the total market cap of all U.S. non-financial equities. So this is all the corporations. They're the ones creating the actual value. The financial entities are stripped out. They actually are not creating value in this story. They're more siphoning. So that's the blue line on the top. The green and the red below are just two ways to express corporate gross value added. That's what are they actually producing? How much are they actually producing that has value? There always should be a relationship between the price you pay for something and its actual value. So that's what we're seeing here. If you thought those first two bubbles got a little out of control, what's up with the third one? This chart from John Hussman, he makes great charts on this. But as well, we've got some negatives to go through. And one of those negatives is negative yields on global issuance of bonds out there right now has crossed the $13 trillion mark. It's actually way over that now. Last I saw, 13.4. So these are negative yielding bonds. Listen, if you don't actually understand what that means, nobody really does. I mean, we can tell you what it's supposed to mean. It means you would pay somebody $1,000 today with the promise that they would give you less than that back in the future. And you'd be tied to a bond which has some other risks associated with it during that period of time. So it's basically a risky guaranteed loss, but yet they're being snapped up. So this is a condition. It's a condition of our current times. This is going to factor in hugely into the pension piece coming up next with Ted. And it's very hard to make money when you have guaranteed losses on the book. So this is crazy. As crazy as that is, I've listed here a nice list put together by Wolf Richter over at wolfstreet.com. These are 14 companies, junk-rated companies in Europe, whose bonds are now floating in the open market that have negative yields. I don't even know how to put this sentence together, but there are negative yielding junk bonds in Europe right now. That's how crazy things have become. The only way you make money on a negative yielding junk bond is if you can sell it at a more negative yield to somebody else. Otherwise, guaranteed losses for you. So that's the world we live in. That passes for sophisticated investing at this particular time as well. We have all these IPOs coming out. We had Beyond Meat. We've got Uber, Lyft, just hundreds of them, right? And the percentage of those that are coming out with negative earnings, these are loss-making companies when they go public, is now back to levels that we haven't seen since the 2000s, which everybody can look back in the rearview mirror and go, yeah, that was crazy. We did some really dumb things back then, but now it's different, right? This time is different as the story, but it's not. This is a really solid negative in this story. And as well, we have these $1 trillion deficits that are just appearing. I think this chart is probably a tiny bit out of date because I'm pretty sure we're going to cross the trillion mark this year as well already. But this is just showing that structurally, in the United States federal budget, there are $1 trillion+ deficits as far as the eye can see right now, or at least the next 10 years or so. And that's without a recession. So if any recession comes along, just take these numbers and multiply by some number, like 2 maybe. We don't know, something big. So the only way out of this story, when you have the most expensive stocks, the most expensive bonds, and by the way, that's what a tiny or small yield means. It means an expensive bond because those work as a seesaw. So as the yields compress down, the prices go up. So the only way you can make sense of a world with super high bond and stock prices, I didn't get into real estate, but those are high as well. The only way out of that is with this miracle thing called growth, economic growth, nominal or real GDP growth. That's what you need. And what's interesting in this story is this is what the central banks are ostensibly chasing. They claim to be data dependent. They claim to be empirical. And we have lots of empirical data. And here's some. Look at the 10-year average of annual growth rates here. What kind of a trend do you see? So this is after everything the central banks have done in dropping interest rates from 15% all the way on down to 0, in some cases beyond. This includes every monetary stimulus that they've ever done. This includes allowing debts to explode. This allowed fiscal deficits to explode. These are their ideas, and their ideas are, well, but this is going to result in growth, everybody, and that's a good thing, but this is the data. The data says the more they do what they're doing, the less growth we actually get. A lot of reasons why that's the case that relate to debt, that relate to resources, things like that. But so we don't have the growth in this story. All right, so here we are in 2019. Adam hinted at this. We've got some macro trouble on the global scene. We look at global trade. It's actually collapsing right now. In fact, we haven't seen figures this bad since when? Well, we'll call that 2009. So we actually have a pretty strong advanced economies in decline at this particular stage, and this is across the world. And as well, when we look at economic growth trends, this is data from Citigroup, what we're seeing is in emerging markets in the United States, in all sorts of other countries, when you look at them all together, we're seeing the worst economic growth trend since, when, right? Back at the prior crisis. So this is actually what the central banks are terrified of. So when they come out and they see stocks at record territory, which they currently are at or very close to, when they see unemployment at record lows, and they say, oh, we're a little worried about inflation being too low, whatever that means to them. What they're really saying is, oh gosh, we saw this in 2016. It scared us. We saw, despite our best efforts, growth slip into negative territory, and they're terrified that what's going to happen is they'll lose control of the situation. That's how I see it. And when they lose control of the situation, there's a big deflation that happens, and things like Italy goes bankrupt, or stocks get crushed, and all the leveraged loans that are out there get crushed. That's what they're worried about most, really, honestly. If you peel back, get your secret decoder ring out, say, what are the central bankers really worried about? They're worried about the markets that they've created, the Franken markets, going into reverse. The problem for them is they don't have a clear path forward either, right? They can't say, and if we do these things, here's how we know growth will return, because it hasn't happened. And it's not that it hasn't happened in the last couple of years. That chart I showed of GDP goes back to 1970. So this is a very long, structural, empirical, data-rich problem they've been facing, and they keep doing the same thing, hoping it's going to turn out a little different. And all they've really done is create more bubbles in a lot of key assets. So that's a very quick tour through the pieces that come together that say, hey, we're on our third largest bubble. It's the most expensive ever. And there's a lot of people exposed to that, but potentially nobody more exposed at this particular stage than the pensions, both public and private. And there are a lot of implications for pensions. And fortunately, we've got one of the leading experts on pensions here to talk about this. If you haven't heard the podcast I did with Ted earlier, you could also listen to that. It does a great breakdown, a longer version than you will have available to you here today, really going through structurally what is going on with pensions and the whys around that. So with that, I am going to stop sharing the screen, and I will turn that back.
Great presentation, Chris. Ted, we're going to hand the baton to you in just a quick sec. I just wanted to mention I believe if you're watching this, at the bottom of your screen, you'll see two icons, one for chat and one for Q&A. People are already beginning to chime in the chat window where they are. They're introducing themselves. Any discussion you want to have occur in there, please do. Use that liberally. And if you want to ask a question of the speakers, submit that in the Q&A option there. I'll be monitoring that, and as time allows, and as the speakers finish going through their main presentations, if I can slip some of those questions in, I will. With that, Ted, it's all yours.
Thanks very much. So as the host mentioned earlier, I began my career as an attorney with the Securities and Exchange Commission in Washington, regulating money managers. And I pioneered the field of forensic investigations of retirement plans, and I've investigated over 1 trillion in these plans. So today we're in the early stages of the greatest retirement crisis in the history of our nation, and even the entire world. In the decades to come, we'll witness hundreds of millions of elders, including the baby boomers here in the United States, slipping into poverty. Too frail to work, too poor to retire will become the new normal for many elders. The good news is that more people globally are living longer than ever. In developed countries such as Sweden, the United Kingdom, Japan, Italy, France, Germany, and the United States, the elder population has skyrocketed. All either already are or are projected to become around 25% elderly. According to the World Health Organization, nearly 2 billion people across the world, are expected to be over 60 years old by 2050, a figure that's more than triple what it was in 2000. The bad news is that almost none, a very, very small minority of these seniors have enough personal savings to pay for decades of retirement. Worse still, those who are counting upon the few remaining corporate pensions for their retirement security can be sure that the company sponsoring their retirement plan, their past or present employer, is consulting with experts, plotting how to screw them out of the benefits they mistakenly think they've been promised. Any so-called promises an employer may have made to workers and retirees are at best shaky or even worthless. Workers in government pensions, on the other hand, can count on politicians and taxpayers running to legislatures and courts to cut benefits workers have been promised when these already struggling pensions start to run out of money. So now is the time for workers and retirees to take action to stop pension looting and protect pensions. Doing nothing, sitting back, confident that your pension check is or will be in the mail is not an option. It's not a risk you can afford to take. So I've spent virtually a lifetime studying pensions and as I mentioned earlier, I've done over 1 trillion in forensic investigations. And with every investigation I do, I learn more. Pensions are extraordinarily complex, and understandably, most people are intimidated when the subject arises. I'm sure you don't want to spend your lifetime learning about pensions, and I don't want you to. Fortunately, the fundamentals of pensions that you need to understand and to protect your retirement security are really pretty easy. There are 3 basic components to the health of a pension: money in, money invested, and money out. By money in, I mean how much money goes into the pension pot. These are called contributions. Money invested is how the money in the pot is managed or invested over, say, a worker's 30-year employment lifetime. And money out is how much money is paid out of the pot in the form of benefits to retirees. If any of these 3 drivers of pension health is amiss, then the pension may falter or fail. Likewise, there are 3 ways to fix a failing pension. Number 1, put more money in the pot. 2, invest the money in the pot better. Or 3, take or pay less out of the pot. When pensions are running out of money or have already collapsed, there's often a lot of talk about items 1 and 2, putting more money in the pot and paying less out in benefits to retirees. However, perhaps not surprising, taxpayers don't want to put more money in a failing pension. And likewise, workers don't want to see the benefits that they have been promised cut. So neither of these fixes to a pension in crisis will work. The least understood and the least discussed cause of and fix to the pension crisis is item 2, mismanagement of pensions and their investments. That's the primary focus of the book I'm co-writing with Robert Kiyosaki, the writer of the best-selling Rich Dad, Poor Dad series, Mismanagement of Pensions. By the way, the title of the book is Who Stole Your Pension and How You Can Stop the Looting. High fees paid to Wall Street for gambling and risky hedge funds and other speculative investments, outrageous investment industry conflicts of interest, and outright violations of law, all of which are forms of looting, are the culprits. Gross malpractice, generally practiced, is what I call it, and it's the norm when it comes to pension investing. The 1 trillion in forensic investigations of dead or dying pensions I've undertaken have concluded that had the pensions been prudently managed, the pensions would not have failed. The pension crisis was, and for many is, still avoidable. No one has to lose the retirement security they were promised. In our upcoming book, we'll show how to quickly determine whether your pension is being mismanaged and concrete steps workers and retirees can take to end decades of pension mismanagement. The critical questions the book will teach you to ask and get answered include: 1, has your pension become less transparent, more secretive over time? 2, is your pension gambling when it should be prudently investing your retirement savings? 3, have the investment fees your pension pays to Wall Street billionaires skyrocketed? And is the pension telling the truth, fully disclosing the lavish fees it pays to Wall Street? Finally, who's looting the pension and what you can do about it? Now, here's a spoiler alert: is every pension I've ever investigated over the past 35 years has become, one, more secretive over time, is increasingly turning to gambling over prudent investing, has seen the fees it pays to Wall Street skyrocket, does not properly disclose the full extent of the fees that it's paying, and misrepresents its performance, and finally, is being looted by various Wall Street firms. So it's important that investors in pensions know what to look for. And I believe if we can raise awareness of these issues globally, there is still time to correct the course that most of the pensions globally have taken, the wrong direction they've gone. But the last thing I wanted to talk about was the special situation when we're dealing with public pensions here in the United States. I wrote an article in 2017 called Top 10 Reasons Why Stealing from State and Local Pensions is the Perfect Crime. And so I list why public pensions are particularly ripe for theft. And reason number one is that with over $4 trillion in assets under management, these retirement systems have boatloads of money. So stealing a few million or a few billion likely won't be missed. Number two, which is really critical to understand, is that public pension funds are overseen by boards of trustees that are comprised of laymen that utterly lack any knowledge of expertise in investment or fiduciary matters. Believe it or not, there are very few state or local statutes which require public pension board members to meet any minimum standards related to pensions. So it's very easy for Wall Street sharks, when dealing with the school teachers, firefighters, police, sanitation workers on these boards, to run circles around them. Another reason that public pensions are ripe for thievery is that they are not subject to ERISA, the comprehensive federal law that protects private pensions. It doesn't really make any sense, but there is this massive loophole in ERISA which says that public pensions are not regulated. And so that's bad enough, but you might think, well, at least there are good state laws protecting state and local pensions. But in fact, there are very few. I call it a thin patchwork quilt of state and local laws. Most of the time when I'm doing investigations of public pensions and we ask the question, is it legal for this pension to invest in hedge funds or commodities or currencies? There is no answer in state law. The state laws just do not have any specifics and are not really written from an investment perspective. They're largely more from a legal perspective. And finally, one of the reasons that public pensions are so ripe for thievery is that there is no federal or state regulator or state law enforcement agency policing these plans for criminal activity. So a would-be thief doesn't have to worry that the U.S. Department of Labor or the FBI or even that state attorneys general will get involved, because there is a reluctance on the state level to get involved in public pensions because of the political issues that, that they're highly charged from a political perspective. So that's the grim picture that I have to tell you, that there is this coming pension crisis, and I'd be interested in hearing your questions.
Hey, Ted, I've got a couple. So I'm thinking, a lot of people have read, the pensions are underfunded, or they're only funded to say 40% or 50 or 70 or some number. Many of the pensions are still carrying really what most people would recognize to be unrealistic assumptions about returns, like 7%, we're going to get 7%. When I just showed that interest rates are in zero or negative territory. There's a lot of thought that interest rates can't rise from here, right? So because if they did, they would blow up budgets and all kinds of things all over the place. But given that sort of dismal backdrop, wasn't it just a couple days ago that some, I'm not totally familiar with it, I haven't got my arms around it, but there was a congressional committee that talked about bailing out at least a part of, or maybe a big part of the Pension Benefit Guarantee Corps. So is there a sense maybe that there'll be federal bailouts on all this at some point?
Well, I'm confident there's going to be federal bailouts of not only the Pension Benefit Guarantee Corporation, but also of state pensions, because we simply cannot allow states to go bankrupt and their pensions to fail. So inevitably there will be federal bailouts, and of course, where's the money going to come from? It's going to come from us taxpayers. Your other point about the investment assumptions, 7% or even higher, that public pensions use, is something that Warren Buffett, in his Berkshire Hathaway annual report for over a decade, has been commenting on. Actually, Warren Buffett has given a great deal of advice to public pension boards. And for those of you who are living under rocks, he is regarded as being the most successful investor of all time. And yet these public pension boards of laymen have consistently refused his advice, neglected to follow his recommendations. And one of them that he has talked a lot about is unrealistic investment assumptions. They are still over 7%. And if anybody can guarantee me 7%, I'd give them millions of dollars to manage, because it's simply unrealistic. He's also recommended that public pensions avoid hedge funds, private equity funds, and primarily look to passive or index investing. Public pensions have completely ignored that advice, and they've loaded up on hedge funds, private equity, venture capital, and they've made these investments through the Cayman Islands, offshore, where they're not subject to the same regulation we have in this country. When I talk to state workers and I ask them, do you believe your retirement savings should be in the Cayman Islands? Nobody agrees with that. No state worker I've ever met wants their retirement savings banked in the Cayman Islands. So lots of good advice from Warren Buffett, routinely ignored. That's why I say pensions are gross malpractice, generally practiced. Even when legendary investors such as Warren Buffett tell public pensions and corporate pensions what the right thing to do, that advice is ignored, and they do the exact opposite.
Ted, a couple of quick questions here, and we're going to have to move on to Brien relatively soon, but so consider this sort of like a lightning round. But we've got one of the watchers here is expecting a pension from Philadelphia. He said that they are still calculating a 7.75% return on the portfolio, just to underscore your point. But his question is what can those of us who are expecting a pension and concerned about it, like, what can we do to monitor how bad things are getting? Where can we find out kind of, where we are in the story on a regular basis? Is there a news source that's out there? Or there's, particular ways to get information beyond just what your pension fund is telling you? What do you recommend?
Well, the great thing about public pensions in the United States is they are the most transparent of any pensions globally. That's the good news. The bad news is they're still not very transparent. But they are subject to state Freedom of Information Act laws. So the Philadelphia system, all these state and local pensions have websites. You can go to their websites and see their investment performance reports. You can see the fees they're supposedly paying, the managers they hire to manage their money, their asset allocation. So I would encourage anybody who's concerned about their state pension or city pension to start, get familiar with the website, get as much information. Another thing is that most of these board meetings are public and are open to the public, and the boards absolutely hate it when the public shows up. So by all means, go to the board meetings as often as you can, ask questions, challenge them, because the people running these pensions, I can assure you, don't know what the hell they're doing. They are not pension experts. And the very fact that the city of Philadelphia would have a 7 3/4 investment assumption is telling. Clearly, someone there is not being realistic.
All right. And Ted, some of the most striking examples of the point you just made about, people being on these boards, not having background in financial management, oftentimes being representatives of the unions that the pensions are for, right? So they're teachers or firemen or police guys or whatever. One of the best examples we saw of that was a Frontline report that I know interviewed you and took much of your analysis into account. I just want to let folks know I posted a link to that, the transcript and a link to the video there in the chat window. If you have time at some point in time, watch it. Just be careful because you're going to have a tough time sleeping that night. Okay, real quick, just short answers on these ones, Ted. We've got a federal employee who's expecting a pension. They're just wondering, is that any more secure than a private pension or any of these state pensions we're talking about? And then somebody living in California, and we've got a number of people from California on the list here, is just asking particularly CalPERS, good, bad, disaster. What are your quick answers to those?
Last question first. CalPERS, disaster. CalPERS, decades ago, was considered the gold standard for public pension, the largest, best managed public pension in the country. It's been mired in scandal, board members, staff going to prison, committing suicide. It's a terribly managed pension. So for those of you either stakeholders in CalPERS, either paying into CalPERS as a taxpayer or relying on CalPERS for your pension, I'd be very concerned. And one of the things I neglected to mention earlier is we've had success. I've done 3 of the first crowd-funded forensic investigations of state pensions. So if people in a state or a county or city want to get together over the internet to pool their money, small donations, to fund a forensic investigation, they can do that. We've done it 3 times. You basically put out what the project will consist of, get people to donate $50, $100 each, and then you hire your expert, whoever you want that expert to be, to do a forensic investigation. That can be very powerful. And as to the federal pensions are generally much better than the few I've looked at, the thrift plan, and than state and local pensions. And corporate pensions are somewhere in between. Some are good, some are not. But as I said earlier, if you're in a corporate pension, it's clear that the people running corporate pensions are hiring experts, trying to figure out how to shut these down and how to screw workers out of those benefits. So watch for that.
All right. Well, thanks, Ted. Sobering stuff. If you're interested by this whole pension topic, Chris mentioned earlier a 1 hour long interview that he did with Ted specifically about this whole pension crisis, which is longer than we have time to go into here. But if you'd like to listen to that, I've also put the URL to that in the chat window as well, and you can listen to that at your leisure. All right, Brien. So we've got a great setup here. Right, Chris told us about the huge concerning risks on the debt side, on the asset overvaluation side, on the growth side. we're seeing a lot of things that are kind of reminiscent of where we were right before everything fell apart in 2008. Ted just basically added gasoline to that fire, right? So as I mentioned earlier, as we look at these huge risks and these huge liabilities that are piling up at levels that I mentioned earlier, really are not going to ever reasonably be effectively serviced or paid off. We're looking at kind of a debt crisis and really a currency crisis, because at the end of the day, you're going to either have just massive deflation if we were to write off these bad debts, which we know that no one politically is going to do willingly, or they basically print to try to keep this game going and you end up killing your currency. So what are some of the answers to that?
Well, great points. And as you said, great setup. And one of the things I'd like to stress to people is, we're talking about the scope of the problem, the size of the problem, but getting back to kind of why we all got together here and why we titled this webinar, The End of the Road, is that these issues are no longer just inevitable. They've become imminent, that we are reaching the end of the road. And, I approach this issue with some degree of cynicism. I've been in the investment conference business and the newsletter business for about 3.5 decades now, and I've seen a lot of doom and gloomers, a lot of pundits coming out and talking about the debt problem over the years, and I've seen it over and over again. So again, I'm somewhat of a cynic coming at this problem, but I've run the numbers now and I've looked at it, and it's a mathematical certainty at this point. We are coming to the end of the road, and there will be repercussions, but there are things as well that you can do about it. So I'd like to go ahead and share some slides that I have here.
Go right ahead.
And go over that, some of the issues. And this is it. This is the big issue, is the federal debts and deficits. And as you look at this is by a great group out of Switzerland, Incrementum, that does an annual report in Gold We Trust. That's absolutely fantastic. But here we see in the blue line public debt, and we see it's growing, and it's over 22 and change trillion dollars at this point. And here, this gets back to some of the things that Chris was talking about. The shaded area, when it's below zero, shows deficits. And only this little bit here where we ever went into surplus, and that was because of tax revenues from the tech boom back in the late 90s. But otherwise, it's been a record that's been basically unblemished by surpluses at any point. And this goes back to this shaded area, again, back to 1971, when we got off the gold standard, cut the last remaining tie to gold, and then central bankers were like teenagers with a bottle of Jack Daniels and the keys to the car. And they just went crazy. And in the 70s, they went right off, drove the car right off into the ditch. But from then on, they were a little bit more circumspect. But with every economic slowdown, they brought in more spending, more monetary easing, and lower interest rates. And like a drug, the patient builds up a tolerance to this. So with each successive event, they've had to increase the dosage. And this gets us to where we are today. Once again, we're going into this period where we have trillion plus deficits, and there are repercussions to this. I want to go over just a few dirty little secrets behind the federal debt. You won't see this on CNBC. You won't see this in your mainstream news organizations. So first off, this is kind of widely reported. The federal deficit for 2019 is expected once again to hit $1 trillion. Now that's massive. We haven't seen that really since 2009, when we were trying to get out of the 2008 crisis with some stimulus spending. But the debt will actually grow much larger. There's about $400 to $500 billion in off-budget spending, Social Security and the like, that gets spent that you never see, never shows up in the deficit. So with a $1 trillion deficit in 2019, you're going to see the federal debt increase by about $1.5 trillion before it's all said and done. And at its historic trend line growth rate, it's about 8.5%, by the way, the trend line growth rate for the federal debt going back to the founding of the Federal Reserve in 1913. So at this long-established trend line growth rate, the federal debt is actually going to reach 30 trillion within the next 3 years. So don't believe anybody that tells you that the federal debt is getting out of control. It's already out of control. So let's look at some of the implications here. The first implication, and you all touched on it a bit already, is that ultra low interest rates are here for good, because higher rates would crush the budget. Now, I've done some work on this. I've calculated the numbers, the effective interest rate, and if the Federal Reserve was ever able to get the Fed funds rate up to 3%, the implication of that would be $1 trillion thereabouts in annual interest costs on the debt. That means $1 trillion spent every year before you spend on national defense, welfare, Medicare, any entitlements or anything else, and much of that money going overseas to foreign investors, including China. Now that level of interest payments to me would be politically unpalatable. The public just would not put up with it. So let's look at this and how those interest expenses are growing. This chart is taken from the Federal Reserve's own website, and you can see the federal debt held by the public. Again, this is not the larger number of 22 trillion or so, but this is just the federal debt held by the public, grew tremendously, and it started its period of very rapid growth right after the 2008 credit crisis. And you can see that shaded area of that Great Recession and how the debt exploded to the upside. But look at that blue number. That's federal government expenditures on interest payments. That's what the government is paying in interest on the federal debt. And you can see that it actually initially dropped and then went up a bit, but it stabilized, because what happened around 2012, 2013 was that, let me go back to that. What happened was a lot of the federal debt at higher rates of interest had to roll off. And then as rates dropped to zero, this zero interest rate policy, what happened was the costs stabilized. Despite the fact that the federal debt was rising so quickly, the interest costs were fairly stable. Let's zoom in on that and you can see what I'm talking about. Interest expenditures really didn't rise much, but again, the debt was soaring. What happened here, this area, when it first started to rise, was the initial Federal Reserve interest hike in December of 2015. That was only a quarter point. And you can see that because the debt was so large, the leverage was so great, just a small increase in interest rates, a quarter point, led to a tremendous increase in bottom line interest payments. And then it took off from there. So the implications of this, again, are that we can never have normalized interest rates again. The second implication is that debts are already uncontrollable. So the only way out of this, again, is that underlying currencies must be devalued. Now, one of the things I tell people is that this is nothing new. There are certain aspects of today's situation, such as the global impact of and the global interconnectedness of economies, that every major developed economy is in the same boat. That's about the only thing that's different about this right now. But throughout human history, going back to ancient times, governments have always overspent their means, whether that's been through military campaigns, whether it's been through entitlements, bread and circuses. They've always done this. It's nothing new. In fact, this is a great chart showing the devaluation of the Roman denarius right after or into the imperial era. What I'd like to point out here is, if you look at the shaded period where the denarius had a tremendous decrease in value, during that period, an emperor had an 84% chance of being killed. Now, the only thing that's probably saved Jimmy Carter and Gerald Ford and a number of other presidents was were elections. Otherwise, they would have met the fate of many of these Roman emperors. This is a tremendous upheaval of the economy and the political environment when you have this kind of a rapid devaluation. Now, if you look at the latter period here, the denarius lost about 80% of its value in a period of about 50 years. Now, a lot of people say this can never happen here, it won't happen in the US. But in fact, it has. This chart going back to 1965 shows the purchasing power of the consumer dollar and how that's plummeted over this period of 55, 60 years. The US dollar has lost about 87% of its purchasing power. Now, it's happened rapidly and it's happened slowly at times, but the bottom line is that the trend line has been from the upper left to the lower right, and it's continuing. So what happens when you get this kind of decrease in the purchasing power of an underlying currency? The reaction in gold is that it rises. Now, this goes back over a very similar period to the previous chart. And of course, you'll see that there are jigs and jags. There are very rapid periods of appreciation, and we have some valleys and some bottoms in here. But over the vast sweep of time, when your currency goes down, gold responds by preserving purchasing power and rising in relative value. One of the things that was very interesting yesterday, in fact, is that gold soared in value, nearly $20, because for a number of reasons. But one of the things that really powered gold yesterday was Ray Dalio of Bridgewater Associates, one of the foremost investors and most successful hedge fund investors in the world today, came out with a lengthy report talking about a paradigm shift in the markets. And basically, he was talking about everything we're talking about today. He covered all of those bases. And because he's so respected, people ran into the gold market because this is what he said. He thinks investments that will most likely do best will be those that do well when the value of money is being depreciated and domestic and international conflicts are significant, such as gold. And I put this chart up here to emphasize again that these trends are now imminent. They're becoming more widely known, and we're going to see more and more money coming into the market as a result. Now, just a couple more charts that I'd like to show. One more from Incrementum shows what the implications are for this kind of cheap, or if negative yields, even free money. If you look at the shaded areas in blue, those are areas when real rates, the real US interest rate, was negative. And that gold line shows the gold price. And as you can see, whenever rates dip below that zero line into the negative zone, it's been tremendously bullish for gold. Here's another chart that's done by a good friend of mine, Peter Bookvar, and you'll see him on CNBC a lot. He's kind of the resident contrarian on CNBC, really a brilliant guy. He put this chart out a couple of weeks ago, and it created quite a stir because nobody really had plotted the correlation between the price of gold and the amount of outstanding negative yielding bonds. And as Chris had pointed out, the negative yielding bonds have hit over $13 trillion once again to record levels. But look how the price of gold in white tracks so closely the price or the value of negative yielding bonds. And as we can see, that value of negative yielding bonds is rising very rapidly at this point. And even the US seems destined to join that club of negative yielding sovereign debt. So everything is working in favor of gold. These trends are, as I say, they're inevitable. And that brings us to these conclusions. Normal interest rates are no longer possible. We can't have higher rates because we just can't afford to pay the interest on the debt, even as it stands today, much less where it's going to be in succeeding years. Sovereign debt levels across the world are so high that they will demand the depreciation of currencies, not just the dollar, but every major currency in which sovereign debt is denominated. So thus, real interest rates will be near zero or negative for the foreseeable future. And that, again, is extremely bullish for metals. It's extremely bullish for commodities in general. And despite some of the problems we see in equities, it's also ironically generally bullish for equities, although we do see some problems coming up in that. So that concludes the presentation, and I'd be glad to take any questions. Adam, I believe you're on mute.
Yes, I was desperately trying to click on mute off. Yeah. Well, great. So, Brien, obviously, with your area of expertise, right? You publish a precious metals newsletter. You just talked about how gold responds well to the type of environment that we see coming. What do you see going forward for gold? I mean, you're somewhat in the forecasting business.
Mm-hmm.
You look out to the next year or two. What do you see for the metals themselves? What do you see for the precious metals mining companies? I mean, they've had a rough go since 2012, let's say, maybe 2011 even. Is it now finally their time to shine? Is it prudent to start maybe adding a little bit back into a diversified portfolio? I know they've done very well since the past couple of months. What do you think?
I believe so, Adam. I really do. I think we're at a key area right now. Gold has, from a technical standpoint, has broken through some strong resistance levels. First in the mid 1300s, then around 1375, then of course $1,400. And above $1,400 from a technical basis, there's a lot of room. There's very little resistance until you get up near $1,800 or closer to the historic highs, the historic nominal highs around 1920 or thereabouts. So we have a lot of room ahead. More fundamentally, we've talked about a lot of the issues that are supportive of higher gold prices. But I can tell you as well that having been in the market and watching the gold price on a daily basis for a few decades now, you get this sense of when it's in a bullish posture, when the metal wants to rise, when the market and investors are searching for reasons to buy rather than excuses to sell. So what they're doing is they're taking bits of news and headlines and data and interpreting that news as bullish and as a reason to buy. And we saw that today with the U.S. shooting down a drone from Iran, and gold immediately spiked. That sort of reaction is typically short-lived and nothing I would bet on, but the monetary drivers for gold are now in place, and it's been confirmed that we are in a significant up move. The good news for investors is that the equities have yet to really respond. So we have the best of both worlds. We have a confirmed trend, but we can still get in at what would be very attractive levels. From these levels, if gold equities, if mining equities would get just to the levels that they got into in 2011, that would imply the average gold stock quadrupling in value from these levels. And that's the average gold stock. So if you have some good advice, if you do some research, if you find some of the better ones, if you go a little further down the food chain into some of the intermediates and junior stocks that might be a bit more leveraged, you can do much better than that. So I do think there's an opportunity here where, and really a need for investors to do two things. Look at preserving their wealth through precious metals, and that would involve some degree of physical holdings, but also look for ways to profit from these trends through precious metals and some of the leveraged equities in the sector.
All right. Well, that's a great segue then to introduce the folks from New Harbor. So, folks, this is a webinar. One of the benefits of a webinar is its interactivity. So, we've kind of had the formal presentations from each of our big thinkers here. Now I really want to start letting the questions flow. I'm going to introduce the folks from New Harbor in a second, but Brien, Ted, and Chris, I'd really like this to be a group effort here. So, if we're asking questions of New Harbor, if you've got any reaction to the guys' responses where you think you can add some additional pearl of wisdom to what they've said, please feel free to chime in. All right, so New Harbor Financial is the financial advisor that is officially endorsed by Peak Prosperity. And the reason why we officially endorse an advisor is that for over a decade now, people come to our site, they read our material, understand our framework for understanding the world. We use this framework called the 3 E's, which is looking through a lens that looks not just at the economy, but the systems in the natural world that an economy requires to function. And we end up coming to a lot of similar conclusions that you've heard Brien just mention. People come to us and say, I think you've got a pretty good beat on the future. I really like how you guys think. But more importantly, I go to my stockbroker and I try to talk to him about some of these things, and he just treats me like I'm crazy. I might mention I might want to own some gold, and he just spends the rest of the time trying to talk me out of it. Or I might mention that I'm uncomfortable about how overvalued stocks are, and he just tells me, don't worry, stocks for the long run. Just be 100% invested and let it ride. So Chris and I spend a lot of time interviewing and working with a number of financial advisory firms to find one that we really liked. And I'm going to let them speak for themselves, but one of the things we particularly appreciate these guys is their focus on risk management. And these guys have not been afraid at all to resist the siren song of the kind of just buy everything and go 100% long that a lot of people in their industry have done. And it's a tough place to be in when the markets are hitting record high after record high, but time and time again, when the market has gone through a downturn, their portfolio has performed much, much better in terms of reducing losses and preserving capital. And that's something that we think is extremely important right now. So with that being said, Mike and John, if you guys could just give a quick, 30-second summary of who you guys are and what your general outlook is, and then I'll get started cherry picking some questions here from the audience.
Hello, Adam. Hello, everybody. Thanks for having us on, Adam. I'd like to take a shot at that. Here at New Harbor, we're hands-on money managers. We manage a relatively small portfolio group of accounts, about $150 million at present. And where our job is to basically assess the risk in the market and react and place our clients' funds appropriately based on how we think the risk environment looks. John and I are both engineers by background. Sadly, we have to admit that. We're engineers. We look at data first and foremost. A lot of this data that we talk about tonight, we look at that, plus other things like valuations, cyclically adjusted price earnings ratios, and other things. And we are by far more overvalued and in a riskier point than we've ever been in our careers. I started in the business in around the 2000 timeframe. John, right around the same time. We went through the tech bubble. Of course, that crashed and came back into the housing bubble. We sidestepped a lot of the housing bubble for our clients. We were deep enough into the business and honed our style enough to avoid most of that through tactical money management. And really in recent years, we've been getting more and more conservative. We're hands-on tactical money managers. We're very largely in cash and cash equivalents now, very heavy in treasury bills. More than half of our portfolio is in treasury bills. The single biggest slice that we have exposed to risk is in gold mining shares. We think there's huge upside in gold mining shares. It's been a long ride, a long bear market in those shares, but of late they've done very well, and we think they've got a long way to go. So most of our job, though, lately is talking to people, talking them off the ledge, keeping them focused on controlling risk, and basically keep them from their own tendencies and fear of missing out in this market. And so we're the sound of reason and caution.
Great. All right. Well, the questions are beginning to come in. While I'm kind of going through them, guys, when a new client comes to you, what are some of the biggest mismatches that you generally see in folks' portfolio given the current environment?
Yeah, well, obviously when someone reaches out to us, the first thing we want to understand is, why did you reach out to us? Obviously, there was an impetus for you to reach out to us. We want to understand where they're coming from. But invariably, the concern points that we'll see are folks that are unwittingly overexposed to risk because they've been seduced into thinking that the risk isn't there, either because of selected data mining, that picking valuation measures that don't look extreme when the ones that really matter are about as extreme as they've ever been, or just being seduced into the mantra that markets always come back, so don't worry about if you suffer a downturn, it'll come back. We haven't met a single client in our careers that has a true long-term time frame. The 25-year-old client has a 10-year time frame because they're looking to buy a house or put their kids through college. The 65-year-old doesn't have a long-term time frame because they're needing to retire and create their own paycheck. So That is without a doubt the biggest area that we see a mismatch, and people being unwittingly exposed to risk either because they don't know they are, or have been seduced into believing that the risk is not there. But interestingly, we also come across a fair amount of folks who see what we would describe as a pretty realistic assessment of the situation, but yet aren't able to act. They're you might call it fear of missing out, or a belief that there will be some reliable trigger point to give them the warning sign to go for the exits. So that's sometimes even more challenging because these folks already see the compelling data, but for whatever reason, their own psychology has kept them from acting upon that. And that's really what we do. We are all about delivering clear-eyed, objective data and drawing conclusions from that, and making sure our clients, prospective clients, are open-eyed about the situation so they can make informed decisions in partnership with us.
Great. Questions are coming in fast and furious now. Here's one, and Brien, I'm sure you're going to want to chime in on this, and Chris, you probably may as well. Can we expect interest rates to go negative in the U.S.? If this happens, will there be any, quote, safe places for money to go to give a return?
I don't know if that question is for us. Maybe one of the other guys.
Yeah, you guys start with it, and then we'll let the other guys chime in if they want to.
Boy, I really have no idea if interest rates can go negative here in the U.S. Our clients ask us that quite a bit, and there's a lot of game theory going on, not only about that question, but a lot of other things, like how long can the Fed keep printing money? How long can the market stay elevated? Who knows? I mean, we're seeing things that we never thought we would see. So we have learned a lot of humility, and we learned to never say never. But my own view is that politically here in the U.S. it'll be really difficult to do. I sense that the public is becoming aware of the wealth disparity that's being created with these policies. I know in Europe it's working. I personally think it won't work here in the United States because of the political pressure that we already see happening. A big wave of kind of socialism already happening in terms of socialist ideas and things like that. It just seems like there's a rising awareness that a few people are reaping most of the benefits of these policies, and I personally don't see that happening. But certainly gold will do fantastic.
Yeah, Brien, I know you have strong feelings here.
That is, the trial balloons have already been floated. Janet Yellen, in her late part of her term, started talking about these concepts. So the fact that the trial balloons are being floated absolutely leaves it on the table as a possible scenario. It may be hard to see that scenario play out, but it's definitely a possibility.
I think it's definitely possible. I think from a real rate basis, absolutely, yes. And I agree, it sounds insane. They had that interview of John Williams today that also helped propel gold prices. Mm-hmm. And they asked him about lowering interest rates at this point in the markets, and he proceeded to recite a litany of reasons why you shouldn't lower rates right now. You have stock market doing great, the economy doing fairly well, everything else. And then he came out with, so of course you really do need to cut rates. It was absolutely amazing to me. Everything added up to 4, and he came out with 8. And not only that, but he was a proponent, I believe, of a half-point rate. And so it's amazingly dovish, and it just seems like logic doesn't work anymore. And the things that are coming out of people's mouths, people in authority, are just mind-boggling to me. So I would certainly not put it out of the realm of possibility. But from a real basis, real interest rates, inflation adjusted, I think definitely they'll go negative.
They'll go negative.
It's going to be in that kind of an environment. Gold, which yields nothing and indeed has a carrying cost, will be the high yielding asset.
Okay. Chris, I don't know if you have the rationale behind this, but how does the Fed get away with looking at record asset prices, pretty much record low unemployment, and the best economic data relative to the rest of the world, and say, of course, we're going to go to zero, which is sort of essentially what they're saying right now?
Yeah, and this is, so much has changed. That's why, webinars like this really very important, because you have to keep your eye on the big picture. And one of the big things that's happened is this isn't a United States story anymore. The Federal Reserve talks about U.S. workers and employment and figures like that and U.S. inflation. But the truth is, that I'm sure they got a call on their bat phone from Europe, which is really having a lot of trouble. In case people haven't noticed, Deutsche Bank is very busy swirling the bowl, and there's a lot of very deep structural banking issues in Europe, and it could really get bad very quickly. China, too. They pad their numbers a lot, but even with those paddings, we're seeing a very, very clear and very sharp, very marked slowdown, a lot of trouble in their credit markets. So again, the bat phone rings. And I think that the Federal Reserve standing here with interest rates that are markedly higher than the rest of the world, they're getting the calls to say, you got to help us out here. You need to lower your interest rates. And then ex post facto, they come up with a rationalization for it that doesn't make sense. They add up 4 and they get 8, and so that's why it doesn't make sense. So when we look at the global picture, this is why, I'm convinced Brien is right in this story that everybody's going to try and devalue their currencies, but everybody can't devalue them compared to other people. So then the question is, devalued compared to what? And that's why I think the stock market is going up and sniffing that out. Gold is sniffing that out. The central banks are trapped. They are now in a printing spree. And of course, the winds of change say, new participants are going to come up and say, hey, instead of bailing out the banks, how about student loans this time? Or, maybe Steve Keen's debt jubilee sounds good to everybody, or whatever it is. You know in your heart of hearts that once you're this far down the printing program, the next act is printing, not a mea culpa and gosh, we got that wrong and fall on our sword, so sorry, and we go through some painful austerity. Nobody's got the heart for that at this point. So the question becomes, how do you manage your money safely? How do you keep your wealth that you've got preserved safe, given that there are all these major participants who are doing everything in their considerable power to destroy the value of those holdings? Because that's the only way out in this particular story. So that's why this prudent money management and gold and things like that really come up. But I wish that we were back in the day when your money was sound and safe and not subject to the fanciful ideas and sometimes fraudulent ideas of unelected officials. But that's where we are.
Right. So Ted, pensions have to hold a good chunk of their portfolios in bonds and fixed income instruments.
Not really. Not really anymore. No. They are increasingly migrating to 50% or more in high risk, high cost.
Okay.
So no, the old rule that pension funds had to keep a substantial amount of their money in bonds is no longer the rule.
All right. And I don't even know if that makes me more scared or not. I was going to ask you, if the Fed drives interest rates down to 0 or God forbid, potentially even negative, what does that do to the bond parts of the portfolios of these companies? Yes, maybe it increases the value of the bonds a bit, but certainly in terms of their returns that they're paying out, those get dramatically reduced. Boy, I feel great that they're just in really risky hedge fund investments instead. So thanks for putting me at ease about that.
Yeah, they're in the highest cost, highest risk, and most secretive investments ever devised by Wall Street. Hedge funds, private equity funds, venture capital funds, and many of them are only like 20% in bonds. And so, of course, the investment returns on bonds impact, hopefully, the investment assumption they assume. So if bond rates come down, then the 7.5% becomes even less, or 7.75% investment assumption becomes even more outrageous. But it's surprising when you forensically look at what pensions are invested in, that very, very little of the money is in low risk bonds and cash.
Yeah, well, wonderful.
Yeah.
All right, so we got a question here. Guys at New Designs, I'm going to address this to you first. Is cash or treasuries that are kept at an investment firm like Fidelity subject to bail-ins? I.e., can Fidelity use my money to bail out its own bad bets in a crisis? What say you guys to that? Because I believe Fidelity is the platform that you guys use to do your trading on, so it's an even more specific question for you.
And they're from New Harbor, and we know that.
Yeah. New Design sounds pretty interesting, though. No,
New Harbor, so.
We use TD Ameritrade as our custodial platform, but for all intents and purposes, they're all the same. The Fidelities, the Schwabs, the TD Ameritrades. The devil's in the details on how you hold your quote unquote cash. We use primarily for our cash allocation, which is very high right now. We use primarily treasury bills. These are, U.S. government securities, obviously. They're not subject to bail-ins or anything like that. They're not proprietary funds of a brokerage house or anything like that. Areas where you probably got to be concerned is, a lot of the sweep options in typical brokerage accounts either go into a money market account, which can technically hold all kinds of even trashy stuff, as was discovered when the reserve fund broke the buck, so to speak, back in 2008, because it held, short-term cash equivalents, which happened to be tied to collateralized loan obligations in the mortgage market, and they lost value, broke the buck, so to speak. So money market funds aren't really a great place to be, generally speaking. There are some that hold entirely, government securities, treasury securities that are relatively safer, but we are big fans of holding the actual securities themselves in the form of short-term T-bills. Most brokerage accounts have a default cash sweep option, which is typically an FDIC chartered bank related to that brokerage house. So things you have to think about there are exceeding FDIC insurance limits, and of course the sanctity of the bank itself. You don't want to necessarily rely on FDIC insurance if the bank itself is in trouble or bound to be. One of the big money center commercial banks that have the ability to kind of do proprietary trading and enter derivative swaps with other counterparties. There was a little talked about law change several years ago in the wake of the financial crisis that essentially classified depositors on these big banks as creditors, not asset owners, to the extent that in an insolvency scenario or a credit situation, these depositors would in fact be behind other derivatives counterparties in the pecking order in terms of settling debts. So that's something to be very careful of. These big commercial banks and proprietary trading shops, when you have deposits on with those banks, you very well could be unintentionally an unassuming creditor of that bank in a scenario, and find yourself behind other creditors in the pecking order in say a bankruptcy proceeding, for example.
Okay. Just a couple quick questions here. One guy asked about the duration of the T-bills you own. Are they 28-day? I know that there are, a variety of different T-bills, which are essentially a year or less in duration, everything from 1 to 3, 6 months to up to a year. Do you guys hold any particular end of that spectrum, or a mix? Or
we're typically very, very short term, 3 months, let's say. We'll typically roll 3-month treasury bills. Have a laddered, kind of spattering of those over a very short period of time. There really is no yield pickup benefit to go beyond that. In fact, 10-year treasury yields, even 30-year treasury yields were recently below the Federal Reserve target rate. We had, the so-called inversion of the yield curve was dramatic and abrupt in the wake of, the Fed's capitulation on their rate tightening path. 2, 3, 4 month type durations is what we're looking at there. They're very good. Really no benefit to go out further than that.
Okay. Here's a question. It's directed to Brien, although I think Chris and New Harbor, you guys might want to chime in on this too. As we entered the 2008 crisis, gold actually, its price was depressed a bit. And part of that was because, during a market crash, investors are just selling anything to meet margin calls. And what do you sell? You sell the stuff that's retained its value. And so that sort of happened to gold. And then once that initial crisis got sort of flushed out of the system, then a lot of capital flew into gold seeking safe haven. Do you see something like that possibly happening again, where there might be a better entry price for gold? Or the specific question here is, has the train left the station already at 1400?
Yes, that could happen. No, I don't think you need to look at that as a trading opportunity or a better entry price. As you alluded to, Adam, in the 2008 crisis, gold was fairly widely held by hedge funds and professional investors. And a lot of people looked at it and said, well, it's a time of crisis. Why is the price going down? And it's important to note as well that it didn't just go down. It would go down, say, $80 to $100 one day, and the next day it would be up $80 to $100. So it's just a period of very high volatility. But people look at that and said, well, why isn't gold soaring? It's not performing its historic role in a financial crisis. In fact, it performed its role perfectly. It was the piggy bank that got broken into when people needed liquidity in time of a crisis. So yes, it got sold because it was liquid. It was ultimately liquid. You could sell it 24 hours a day anywhere. And so people are stock investors who are getting margin calls sold their gold, met their margin calls, but then other people rushed in and gold went up. It's important.
Well,
All right.
Brien had a little hiccup there. Hopefully he'll come right back on. But in the interim, hopefully he can come back on and finish that point, because I think it's a great point to make. Chris, just a direct one to you that just came up. Somebody just finished listening to the interview that we published this week with Martin Armstrong, who basically said, hey, it's not necessarily fair, but capital is going to continue flowing into the U.S. equity market for a whole bunch of reasons, but largely because it's the cleanest dirty shirt, all that type of stuff. And he made the call of, hey, don't be surprised if you see Dow 35,000 by 2021. Do you see that as even being potentially realistic here?
Well, yes, if we get a lot more of the printing that we've been seeing in the financial easing, that's always a possibility. However, right now I still believe fundamentals have some role in this story. I know that's a very archaic view, but we do have this global slowdown that we have to really keep an eye on, and the United States is going to be very exposed to that as well. So a lot of the drivers of why the Dow even made it to the 27,000 mark included corporate buybacks, multiple expansion, lots of things besides an actual increase in overall aggregate corporate earnings. Earnings per share is up. That's because there's fewer shares out there in the divisor in this story, right? Because they bought those back, but also levered their balance sheet up to really, in corporations' cases, really take on a lot of debt to fund the share buybacks. A lot of those drivers are now slowing down. Martin's point was that, hey, but there's all this global capital in the world, and what you really have to understand is the flow of that. So if people don't like Europe and you have $1 trillion or $2 trillion under management, where do you go? Well, so that I'm sympathetic to that particular argument, but I'm not really going to bet a whole lot on that at this particular juncture, because I believe that the forces of deflation right now, of global slowdown, are stronger. Again, they might print their way. We might see this lifting off again. That could happen, but it'll be fairly temporary. And an interesting point of alignment, Martin Armstrong's model says, hey, we're going to get this big change, this big shift into an inflationary spike. It starts in January of 2020. Our own work at Peak Prosperity says, wow, there's a missing $1.5 trillion of upstream oil and gas investment. Eventually, that's going to bite into supplies, and that's probably going to start hitting in the early 2020s, right? So I could see that cost push inflation coming through from oil at that point in time. So that would actually be the worst of all possible worlds. We're back to the 70s, right? We're back to stagflation. Poor and middle-class people who are already struggling find, yay, lots of happy inflation that the Fed wanted so badly. It comes, but we still don't have the associated wages to help with that. And so it's actually not a good place to be. There, you really want to be able to protect whatever wealth you have and understand that dynamic. So it's possible we could see Dow 35,000. I never thought we'd see Dow 27,000, but here we are. And printing is proven to be a very magic Exler.
Well, I don't drink, but I commit to becoming an alcoholic if we indeed hit Dow 35,000 by 2021. Brien, good to see you back. We're approaching the end of our time here, so I want to give you the opportunity to have the last word if you still wanted to finish up with the point you were making there.
Sure, and what I was trying to do before my computer decided to take a timeout was remind people of how things were way back in 2008 and how perilous the situation was at that point. We were really very close to a banking holiday. I mean, we had everybody meeting, all the financial maestros meeting in Washington to do unprecedented and illegal things to try and rescue the economy, the banking system, and everything else. And it's my firm belief that we're going to reach that kind of a situation again. And so history doesn't always repeat it, it rhymes and all of that. So we don't know exactly what the course will be going forward. But I think it's important for people to know that they should have physical metals. They should have exposure to gold and mining stocks, and they need to be diversified. We're not telling people, some of the questions that were coming up were, should I be in cash or should I be in gold, or when should I switch, and this. You really can't tell, and you can't give advice to people to that granular level of what the best strategy is going to be. They need to be diversified. They don't need to be all in gold. They don't need to be all in cash. They need to be allocated and positioned for what's coming up, which is uncertainty. And going into this kind of uncertainty, to the degree and with the kind of repercussions we talked about, you absolutely do know that you need to have a healthy allocation to certain things like precious metals, particularly gold and silver, mining stocks, and some other defensive portfolio strategies.
All right, so Brien, that's an absolutely excellent segue into my closure here. So before I go in and give people some direction on where they can go to learn more about each of the speakers here and some of the resources that they provide, I would love it if you've got a moment just to chime in the chat window if you'd like to see more webinars like this by this group, because there were a ton of questions we didn't get to. One just came in on cryptocurrencies with 1 minute left, and I was like, there is no way we're going to be able to do that justice before we break up here. But if you would like to see more webinars like this amongst this crowd of experts, please just chime in yay or nay on the chat window there. So Brien just mentioned that one of the real, I think, nefarious parts about what's going on right now is there is no easy way to sit this one out. There's no easy way to sit on the sidelines and guaranteed safety like there has been. So you really do need to hedge your bets, to be diversified, to employ hedging, really, as a risk management tool. That is a huge, huge reason why we endorse the guys at New Harbor Financial, so that people have an option of getting advice on ways they can do that. So the guys at New Harbor, if you want to talk to them, you can just go to the URL that's here on the screen, greylockpeak.com. They will give you a free consultation. They will be happy to provide a free portfolio review for you. There are no strings attached. It does not cost you anything to reach out to them. It does not cost you anything to have that meeting with them. This is really a public service that we at Peak Prosperity are providing, and the guys at New Harbor are kind enough and skilled enough to give the time to people like you, because they are people like you. So again, if you want to talk to New Harbor, go to Greylock Peak and schedule your own consultation there. If you want to learn more about what Chris Martenson was talking about, you can come over to peakprosperity.com, and for whatever reason, my PowerPoint is being stubborn, just like Brian's computer was. It's not advancing on me. So that's peakprosperity.com, P-E-A-K, prosperity.com. We also offer a premium newsletter service, which has our best and most directed guidance, our best analysis, our most directed guidance. That's available at peakprosperity.com/enroll. And Ted, you are, sorry, it's benchmarkalert.com?
That's it, right?
Awesome. Benchmarkalert.com. I'm sorry, folks, we'll put these placards up on the replay video that everybody gets. And in that same placard for Ted, we have a URL to his past articles on Forbes. So if you want to learn more about Ted and specifically about the pension crisis, you can read those articles, or you can listen to the podcast, and I provided the URL for that, or you can watch that Frontline report. Any one of those is guaranteed to make your hair turn white overnight. Brien, yours is goldnewsletter.com for folks that are interested in following you and your advice and your analysis on the precious metals. And there's the New Orleans Investment Conference, which Chris and I go to every year. The guys from New Harbor go there too. Ted, I don't think I've seen you there yet, but we've only recently met. I hope we get to see you there at some point.
Yeah, hopefully I'll get there.
All right, well, that'd be wonderful if we see you there soon. And that is neworleansconference.com. Is that correct, Brien?
That's it.
All right. So everybody who's been watching this, thank you for spending your time with us. It looks like the feedback we're getting in is folks would love to see more of these in the future. We will send everybody who registered for this event a link to the replay video probably at some point tomorrow. So if you want to get a chance to rewatch it, or if you didn't get a chance to watch all of it because you got pulled out, or you want to share it with friends and family members, all of that is wonderful. You'll get that link to that tomorrow. And with that said, I just want to personally congratulate each one of our guest experts today, Chris, Brien, Ted, Mike, and John. Thank you so much. Everybody, that's it for this time, and we'll see you all soon. And we'll keep tracking what happens in the world here, and hopefully helping people make smarter, better, and safer decisions.
It's been our pleasure. Thank you.
Thank you.
Thank you.
Goodbye, everyone.
Right.